Welcome to the deep dive. We've got all your source materials here, the articles, research, even your own notes, and we're going to dig into what's really moving the US Forex market today, June 13th, 2025.
Yeah, and our goal here is really to sift through everything you've gathered, pull out the most critical insights, and help you understand the complex forces really shaping currency movements right now.
And looking through your material, it's clear today is dominated by a serious tug of war.
Yeah.
The sources really point to two massive themes. First, those heightened geopolitical tensions.
Right, which are just slamming headfirst into the second theme, that ongoing divergence in monetary policy among the big central banks.
Exactly. And that combination, as your notes make clear, is creating a really complex and, frankly, pretty volatile trading environment.
Definitely volatile. So let's maybe jump right into those key drivers, starting with the geopolitical angle.
Absolutely. That seems to be the immediate shock. Your sources pinpoint the main event, those overnight Israeli airstrikes on Iran. Reports suggest they targeted a senior IRGC figure and possibly nuclear facilities.
And the reactions from leaders, according to your notes, haven't exactly calmed things down. You've got quotes like Netanyahu saying operations will continue for as many days as it takes to deal with Iran's uranium threat.
Right, and then President Trump suggesting even more brutal strikes might be needed.
While on the other side, Iran's Ayatollah Khamenei is threatening harsh punishment. It's pretty intense rhetoric.
And the market reaction, well, it was textbook, wasn't it? A classic risk-off move.
Totally predictable. Equity futures took a hit. Dow, S&P, NASDAQ, all down around 1%.
Money just flowed out of riskier assets and into traditional safe havens.
Yeah.
Gold jumped over 1%, right? Trading near those late April highs.
Uh-huh. But the real eye popper in your material was oil. Crude futures just exploded, up 8%.
8%? That's huge. Puts prices near their highest since early 2025.
Yeah, that's a serious risk premium being slapped onto the market almost instantly. And that obviously has major implications, especially for commodity currencies.
Definitely. And adding another layer of complexity, your sources also flagged the ongoing uncertainty around U.S.-China trade. There's talk of a framework agreement.
Right, with the U.S. focused on getting those rare earth mineral exports flowing again.
But then you have President Trump's somewhat ambiguous stance, offering to maybe extend that July 8th tariff deadline.
But also saying he's ready to slap on unilateral tariffs within 2 weeks if needed. That kind of mixed messaging just keeps everyone guessing, especially for trade-sensitive pairs.
Okay, so that's the geopolitical powder keg. Let's pivot now to the other major force you mentioned, monetary policy divergence. The central banks are definitely not all on the same page.
Not at all. And starting here in the U.S. with the Fed, your notes show the effective Fed funds rate is sitting at 4.33%. And of course, President Trump keeps publicly pressuring Chair Powell for rate cuts.
But here's the really crucial part based on your sources. The market's reaction to the softer U.S. inflation data we got earlier this week, CPI and PPI, it's been, well, dramatic.
Yeah, the market is now pricing in a much higher chance of Fed cuts this year. We're talking exceeding 2 full 25 basis point cuts by year end, according to the pricing.
And that expectation jumped significantly just this week, right? Like 15 basis points higher.
Exactly. A big shift in sentiment just in the last few days based on that data. But here's the tension. Despite the market practically screaming for cuts, the consensus from your material is that Fed officials themselves are likely to hold steady at the upcoming June meeting. They seem to be sticking to that wait-and-see approach.
Okay, so the Fed's watching and waiting, but across the pond, the European Central Bank, they already acted.
They did. They pulled the trigger on that 25 basis point rate cut back on June 5th, and it just became effective June 11th.
So their rates are now lower. Deposit facility at 2.00%, main refinancing 2.15%.
Marginal lending at 2.40%. And the rationale, based on your sources, was inflation settling near their 2% target, coupled with, economic headwinds and all the global uncertainty. It's a clear dovish pivot.
And their own internal projections seem to back that up. Your notes mentioned forecasts for inflation around 2% this year and in 2027, maybe dipping a bit in 2026, and pretty sluggish GDP growth, like 0.9% for 2025.
A very different picture compared to the U.S. situation. And then you look east to the Bank of Japan. Their overnight call rate is still just around 0.5%.
Governor Ueda has kind of hinted they might raise rates if the economy really picks up.
Right. But the expectation outlined in your research is that they'll likely keep rates unchanged at their meeting next week, June 16-17.
Even though Japanese core inflation, excluding fresh food, has been running hot, right? Above 2% since way back in April 2022. and it hit 3.5% in April.
Correct, but their continued hesitation to tighten policy more aggressively, despite those inflation numbers, is key. It maintains that really wide interest rate gap with the U.S., although, as we'll get into with USD JPY, there are other dynamics, like capital flows, really stirring the pot there, too.
Wow. Okay, so the backdrop is incredibly dynamic. You've got this major geopolitical shock hitting a market already wrestling with these diverging central bank paths.
Precisely. So with that big picture established, let's drill down into the specific currency pairs your sources highlighted as particularly interesting today.
Right. And the criteria mentioned in your material seem to focus on pairs with significant volatility, good liquidity, any weird sentiment spikes, and just generally being talked about a lot.
Yeah, it gives us a nice mix majors, a commodity currency, an emerging market pair. Lets us see how these big global themes are playing out differently across the board.
Okay, let's start with the giant.
Yeah.
USD. What's the main takeaway from your sources for this pair today?
The absolute number one driver here, according to your analysis, is that widening policy gap. You've got the ECB actively cutting,
This week.
while the market is simultaneously ramping up bets on future Fed cuts because of that soft U.S. data. That divergence is the core bullish argument for the euro against the dollar right now.
Makes sense. So the fundamental story is euro positive on policy. But technically, your notes pointed out, it recently bumped up against that 1.1500 level, a multi-year high.
Right, highest since June 2021.
But momentum indicators like RSI and MACD are starting to look a bit stretched, maybe hinting at being overbought, suggesting a pause or pullback could be coming.
Exactly. There's that hint of technical overextension. But the short-term trend is still generally seen as bullish. The geopolitical risk today does put some temporary weight on the euro, as you'd expect in a risk-off scenario. But those rising Fed cut expectations are acting like a ceiling on any potential sustained rally for the U.S. dollar.
Okay, so putting it all together, the synthesized view from your sources leans bullish on Euro USD, but maybe watch for some short-term consolidation or a slight pullback.
That's the gist. And the projected trading zone they see for the next 24 hours is between 1.1450 and 1.160.
With confidence score of
7 out of 10.
Yeah.
Pretty decent conviction there.
All right, next up, GBP USD, or cable, also very liquid, obviously responds to UK and US data, and definitely sensitive to this risk mood.
And here, your notes flag a technical warning sign on the daily chart, something called a rising wedge pattern. Analysts often interpret that as potentially bearish.
Okay. And there was also mention of bearish divergence on momentum indicators, another technical hint that the recent climb might be running out of gas.
Precisely. And the price did take a tumble recently, dropping below 1.3550 when that risk-off sentiment hit after the Middle East news. Your material points to the 50-day moving average, down around 1.3315, as a possible downside target if this weakness continues.
Even if the very short-term charts looked okay, the bigger picture momentum seems to have stalled out a bit.
Yeah. Fundamentally, the pound is feeling that downward pressure from the risk aversion. But, like the euro, it's getting some offset from the soft U.S. data weakening the dollar's outlook. UK data itself is a mixed bag. You had that unexpected inflation pickup, but also a drop in payrolls.
Looking at recent price action, the pound did climb in May, hitting a high near 1.360.
A 3-year high, yeah.
But over the past week, the gain was tiny, like 0.2%. Really confirms that loss of momentum.
So, putting that all together, the bias from your sources for GBP USD comes out as neutral to slightly bearish.
An unprojected zone.
1.3480 to 1.3580 for the next 24 hours. Confidence score here is a bit lower, 6 out of 10.
Got it. Moving on to USD JPY. High liquidity here too, but the key thing your sources noted was the exceptionally high implied volatility for the yen today, way above its average.
Yeah, that signals the market is braced for potentially significant price swings in yen pairs. It's a really important one to watch for tracking central bank policy differences, risk sentiment, and those capital flows we mentioned.
Technically, your notes show USD JPY is currently testing a pretty critical support level, right around 143.95. That's also near the 50-day moving average, a widely watched line.
And some technical analysis mentioned, like Elliott Wave, suggests that if it stays below resistance around 145.50, there could be potential for a continued drop, maybe towards 138.65 or even lower eventually.
Though the price has bounced around that 143.95 level recently,
Yeah.
and shorter-term momentum indicators look oversold, which could mean a short bounce is possible.
It could, yeah. A bounce isn't out of the question from oversold levels, but it doesn't necessarily negate the bigger picture risk if that key support at 143.95 breaks decisively.
Fundamentally, it's interesting. Even with the huge yield gap favoring the dollar, some of the recent upward movement in USD JPY, according to your sources, might be due to things like portfolio reallocations and capital flowing out of Japan.
Right. It's not just about interest rates anymore. Flows seem to be a major driver. And the BOJ's cautious stance, despite inflation, obviously helps keep that yield differential wide, supporting the dollar fundamentally. But these flow dynamics add complexity.
In looking at the short-term trend, USD JPY actually gained 0.7% over the last week, showing some recent bullish momentum, which is kind of counter to the historical tendency for June to be slightly bearish for the pair.
So sentiment is really mixed. The yen is a traditional safe haven, which should benefit in times like these.
But it's also being pushed around by these flow dynamics.
Exactly. So the synthesized bias from your sources ends up being sideways to slightly bearish for USD JPY. The projected 24-hour zone is seen between 143.00 and 144.50.
Confidence score also 6 out of 10 here.
Okay, next. USD CAD, the loonie. High liquidity, but the big thing here is it's linked to commodities, especially oil, and its sensitivity to U.S. economic news.
Technically, your notes described a bit of a mixed picture here, too. Some very short-term charts might show an upward break, but the bigger trend looks clearly down lower highs, lower lows, trading below key averages like the 200-day EMA.
Yeah, the overall technical rating mentioned in your material leans towards sell for the day or week. Support is pegged around 1.360 to 1.361. with resistance maybe up near 1.3700. Momentum indicators are also suggesting the recent upward push might be running out of steam.
Fundamentally, this is where things get really interesting. You've got the US dollar getting that temporary boost from risk aversion.
BUT, the Canadian dollar, is getting massive support from that 8% surge in oil prices. That's a huge positive for the loonie.
And perhaps even more importantly, your sources highlighted imploding yield spreads between the U.S. and Canada.
Yes, this is crucial. Market expectations for Fed cuts are rising, while expectations for Bank of Canada cuts are actually decreasing. That narrowing interest rate gap is a powerful fundamental force pushing down on USD CAD.
That yield spread dynamic sounds really dominant. And the Canadian dollar has strengthened recently, right? USD CAD down 0.3% over the last week.
Showing that recent bearish momentum. So sentiment is this battle, USD safe haven appeal versus CAD strength from oil, and importantly, those shifting yield expectations.
As the overall bias
comes out as bearish for USD CAD based on your sources. The projected 24-hour zone is 1.3580 to 1.3680.
confidence score.
7 out of 10. Stronger conviction here due to those fundamental drivers like oil and yields.
All right, last of the top 5. USD MXN, giving us that emerging market perspective, your sources flagged a high volatility prediction for this pair today.
Yeah, indicating bigger swings are expected. It's very sensitive to U.S. developments and the overall risk mood, as you'd expect.
Technically, the picture here seems pretty unambiguous according to your material.
Yeah.
A strong, persistent downtrend basically all year.
Very clear trend. Price is well below key moving averages like the 50-day and 200-day, and both are sloping down, confirming that bearish momentum.
Momentum indicators like the RSI are getting near oversold territory, which might suggest a pause or a small bounce.
Right. It hints maybe the selling is getting a bit exhaustive short term, but crucially, your notes say there are no signs yet of a major trend reversal. Key support levels are cited around 19.08, 19.05, and even 19.00, with maybe 18.58 as a further target downside.
Fundamentally, the peso has been under pressure, hitting its weakest levels since the early pandemic days. Your notes suggest part of this is investors shifting money into U.S. dollar assets, maybe as an inflation hedge.
And the Mexican economy facing its own domestic challenges. Though the material does mention the Mexican central bank and government are reportedly trying to stabilize things.
Short-term cycle shows a significant drop over the past week, reinforcing that strong bearish momentum alongside that high volatility forecast for today.
So pulling it together, the synthesized bias for USD MXN is clearly bearish, while acknowledging the possibility of those short-term bounces from technically oversold conditions.
Projected zone.
18.9 to 19.10 for the next 24 hours, and the confidence score is also 7 out of 10.
Okay, that covers the top 5 pairs in detail. Now, let's maybe dig into some of those other quantitative and sentiment indicators your sources mentioned. How do traders try to get an extra edge or confirm these views?
Good question. Your material touched on things like open interest and the commitment of traders, or COT report. The COT report is useful because it shows how big players, speculators, institutions are positioned. The caveat is the time lag. Today's report actually reflects positions as of Tuesday.
Right. But even looking back at the June 3rd data mentioned in your notes, it showed large speculators were increasing their bets against the S&P 500, more short positions.
Exactly.
Yeah.
Which suggests growing bearishness on stocks. Now, sometimes that can correlate with demand for the US dollar as a haven, but it's complicated today because the dollar itself is facing pressure from those Fed cut bets. Your material also noted increased open interest in euro futures, suggesting more market participants are getting involved there.
And sentiment gauges were flashing red too, right?
Yeah.
The VIX, the fear gauge.
Yeah. The VIX was up today, indicating rising market anxiety, and the US dollar index, the DXY, which measures the dollar against a basket of currencies. It had been plunging recently on that soft US data and all the tension.
Reaching multi-year lows down near 98.70.
But it ticked up slightly today, getting a small lift from the risk aversion. However, your sources pointed out that even though it looks technically oversold, there aren't clear signs it's exhausted its downward move yet. Those traditional correlations seem a bit scrambled by the immediate geopolitical shockwaves.
Your sources also briefly mentioned how more advanced analysis, like AI, could conceptually be applied here, hinting at even deeper ways to analyze this complex market.
Right. Things like Monte Carlo simulations. Your notes describe them as ways to model thousands of possible future scenarios based on historical volatility, interest rates, data surprises, etc. In a market like today's, with high implied volatility and geopolitical uncertainty, these simulations could help map out potential price paths and, importantly, flag those tail risks, the less likely but high-impact outcomes.
And Bayesian inference models.
The idea there is using models that constantly learn and update their probability estimates as new information hits the wires, a surprise economic number, a central bank comment, another headline out of the Middle East. They'd refine the odds of a currency moving up or down based on the latest data flow.
And finally, that concept of order flow analysis, or whale watching.
Yeah, that's about looking beyond just price and trying to see where the big institutional money, the whales, might be moving. Analyzing the size and aggression of buy and sell orders, activity in dark pools. It's about trying to detect if the smart money is positioning strongly in one direction, which could help confirm biases seen elsewhere. Especially relevant today with those sharp, sudden moves in things like gold and equity futures.
Okay, so pulling all of this together, the major themes of deep dives on the pairs, these extra layers of analysis, what's the absolute core takeaway for you, the listener, navigating the market today?
It really boils down to that intense push and pull. On one hand, you have the geopolitical fear driving demand for safe havens, which gives temporary lift to the US dollar, gold, etc. But working directly against that is the central bank divergence story, especially the market piling into bets on Fed rate cuts after that soft US data that fundamentally undermines sustained dollar strength.
And if we quickly recap the synthesized biases for those 5 key pairs from your material.
Leaning bullish thanks mainly to that policy divergence. Zone 1.1450, 1.16 center 0. Confidence 710.
GBP USD. Neutral is slightly bearish. Technical correction signals and risk-off headwinds are weighing on it. Zone 1.3480, 1.3580. Confidence 610.
USD JPY. Sideways to slightly bearish. It's a messy mix of capital flows potentially fighting fundamentals, technical levels in play, and the BOJ staying put. Zone 143.00, 144.50. Confidence 610.
USD CAD. Clear bearish bias. Those narrowing U.S.-Canada yield spreads are a big driver, plus the massive oil price surge supporting the loonie zone. 1.3580, 1.3680. Confidence 710 day.
And USDMXN. Also bearish, following that strong downtrend driven by domestic factors, though watch for those potential short-term bounces. Zone 18.90, 19.10. Confidence 710.
And your sources likely touched on potential strategies implied by these biases. Things like maybe looking to buy dips in USD or sell rallies in GBP USD and USD JPY, or perhaps considering outright shorts on USD CAD and USD MXN based on specific levels identified in the research.
Absolutely. But it's crucial to stress this entire analysis is a snapshot based only on the sources you provided for today, June 13th, 2025. Things can change fast.
Incredibly fast. Vigilance is definitely the word today. Those geopolitical headlines could shift the mood in an instant. We've still got that U.S. University of Michigan Consumer Sentiment Report coming out later today.
And the inflation expectations component of that will be key for Fed speculation.
Exactly. Plus, the full COT report later will give us an updated, though slightly delayed picture of how institutions were positioned earlier this week.
And given the high implied volatility mentioned in your sources, particularly for pairs like EUR/USD and USD/JPY, risk management is paramount.
Absolutely non-negotiable. thinking carefully about stop losses, position sizing. That's critical in this kind of choppy, uncertain environment.
Well, this has been a really insightful deep dive navigating these pretty significant geopolitical shocks alongside the ongoing central bank drama.
It certainly has. Thanks for bringing all this material together for us to explore.
And just one final thought to leave you with, something to mull over. We see the market today aggressively pricing in multiple Fed rate cuts, largely based on recent weaker economic data prints. But that consumer sentiment report later today might show consumers themselves are actually getting more worried about short-term inflation, maybe even spooked by that huge spike in oil prices we saw.
That's a really interesting point. What happens if the market's bet on the Fed easing runs smack into persistent or even rising consumer inflation fears?
It's a potential clash worth watching closely, a key conflict point in the data right now.
Definitely something to keep tracking as this complex situation continues to evolve.
Keep exploring, stay informed, and thanks again for diving deep with us today.